The affordability equation is the next really important part that we need to nail to get you to the start line to buy your first home. As a really rough rule of thumb, you can borrow between 5 and 6 times your pre-tax income. That's just as an indication of a number to get you started, but we do need to look specifically at the bank calculator to give you a more accurate number. And when we're establishing a more accurate borrowing capacity figure, we have to take into account everything to do with your financial position. So we look at all of your income sources, all of your expenses, your household expenses that are in place right now, or anything that's going to start when we go forward, like rates or insurance, and any other personal commitments you may have, like student loans or personal loans. What that does is that pulls everything together onto one page, and it shows us a number at the bottom that's either a surplus or a deficit, and then we adjust that to figure out where your maximum borrowing capacity will sit. When the bank's looking at your home loan repayment amount, they use what's called a stress test interest rate, and that's usually about 2% higher than what you actually pay on market at the moment. And they do that to make sure that you can still afford your loan if interest rates do increase. They also use what's called benchmark expenses, and that may be a little bit higher than what you declare. It just depends on what your position looks like. So if those benchmark expenses are higher, that's the figure that they'll use going in. If you're an employed applicant, we'll look at your salary income, but we'll also look at any other variable income you might have, like commission, overtime, or allowances. And that income gets sensitized, and the amount that gets sensitized depends on the bank. If you're a self-employed person, generally we need to provide 2 years of financial statements and tax returns. That's not always hard and fast. There are some exceptions to that. We may be able to use forecast income if needed, but I'll figure out that with you and figure out the best way to present your numbers to the bank. If you're self-employed, they'll look at your salary that you've paid yourself plus the net profit from the business left over after that. And we can also add back things like interest, depreciation, and home office. And the bank allows us to do that because it may actually just be an on-paper expense, and therefore it is income that's available to use to service your outgoings. We also need to consider any liabilities or commitments that the business might have. So that could be vehicle loans that are actually held in the business, or anything else that you've committed to that needs to be factored into on an ongoing basis. So there's a lot to think about when it comes to the affordability side of things, and I'll sit down with you and figure out the best way to present your numbers to the bank to give you the best chance of approval.